Hello everybody. In this video we are going to discuss about India's 12, that is income tax related, and here the what is this objective of this standard means. Here we need to describe accounting treatment for income tax, accounting treatment as per Companies Act or books of accounts, accounting for the current and future consequences, how we can future we can recover, that is settlement will happen, and how the transactions or other events current period that we are recognized. So how we can recognize it in profit and loss account, how the transactions will recognize it in profit and loss account. So transactions and events recognized out of profit and loss account, that is related tax effect recognized in OCI, related tax effect recognized in statement of changes in equity, transactions and events recognized in profit and loss account. So related tax effects also recognized on profit and loss account. Firstly, for this we should know what is there here. So here mainly we are talking about the tax expenses. Now what is there in tax expenses, what is mean by current tax, what is mean by deferred tax. Firstly, the current tax means simply normally tax expenses. So normally tax expenses means we need to take current tax plus or minus deferred tax. This is the main purpose. So now we should know about the current tax and what we should know about the deferred tax. Now current tax expenses means it is the amount which it is the amount of tax payable on profits calculated as per income tax act for that period, that is current tax. Now deferred tax means what? Here we are adding or deducting the amount. Deferred tax means simply it is temporary saving in tax or payment of some additional tax due to some temporary difference between the carrying amount and tax basis. So we have the this amount will be payable or recoverable in future in respect why we are going for future, because now it have some temporary difference or some unused tax classes or some unused tax credit. This is main area. Now temporary difference into tax rate, you will get this amount. So here the temporary difference will be carrying amount into tax base. This is the main core area. So how we can get the temporary difference? For example, if we see depreciation rate as per books of accounts, depreciation rate will be 25%, and as per income tax rate it will be 30%. For example, I am taking the example. Then whatever the amount we are charging, as per books we are charging this amount, as per income tax we are charging this one, we are getting some 5% different for current period, and later years this amount will be adjusted in later years. So here whatever the actual payment we are paying now, that is current tax, means we will pay at 30%, and as per books will be some difference amounts. Each year we need to recognize some future tax liability. If we are paying more, we need to recognize it as a deductible amount. Now it is the main area. Now what is the entry, what is the recognition entry for this case? So now firstly we are getting the current tax. How we can recognize the current tax expenses? Current tax expenses account debit to provision for tax amount. So provision for tax amount, this will transfer it to profit and loss account or OCI. Provision for tax will be the current tax liability. Okay. Now the current tax is recognized in profit and loss account or OCI according to the item on which it is created. If it is related to P&L items related, we need to transfer it to profit and loss account. If it is related to OCI, we need to transfer it to OCI. For example, we have foreign foreign capital gain related amount, foreign currency capital gain related in amount, it is there in OCI, then we need to transfer that amount to OCI. Now if we paid any advance tax, then what will be the entry? Advance tax amount debit to bank. What debit, what comes in, credit what goes out. It is relating to current tax. Now we talked about the other tax, that is relating to deferred tax. So how the entry will be passed for this deferred tax? As per Ind AS, we should follow, as per Ind AS, we should follow balance sheet approach. Which approach? Balance sheet approach we will follow for this purpose, for deferred tax amounts. Now whenever the deferred tax, we are following the balance sheet approach. Now in balance sheet approach we use to calculate this deferred tax. How we can calculate this deferred tax? Now firstly, it should be calculated on temporary difference between the carrying amount and the tax base of asset liability. So for asset liability we should calculate the tax base. Next we should know about the carrying amount, means balance on relevant assets or liabilities in the books as per India AS. So what is the amount there as per India AS? As per India AS, as per income tax, what is the rate? So here we should know the amount from both side, item having the tax base which is there in, as per balance sheet, as per Ind AS. Now tax base means here tax base means amount of relevant asset or liability that would appear in income tax balance sheet if it is prepared as per income tax liability. Now temporary difference, we will get the temporary difference between the carrying amount to the tax basis. When with this temporary difference we are getting, if this temporary difference is taxable temporary difference, or if the amount is deductible temporary difference. Taxable temporary difference means what? Taxable temporary difference means it is leads to additional payment of tax in future. So taxable temporary difference, taxable temporary difference means we need to pay that amount in future. Now this is deferred tax liability is created on taxable temporary difference. If it is a TTD, if it is a TTD, we need to create the DTL, deferred tax liability. Here for amounts, if the carrying amount greater than tax base, carrying amount greater than tax base, or carrying amount of liability, here carrying amount of asset, here carrying amount of liability is less than tax base of liability, then we will create the DTL, that is deferred tax liability. Now after us, deferred deductible temporary difference, if it leads to saving of tax in future, so we are saving some amount for future, then DTA is created. What we will create here? DTA. If it is need to pay, we will create the DTL. If we are saving, we will create the DTA. DTA will be created on deductible temporary difference. Here same, the carrying amount of asset, here we are taking greater than, now we will go with less than the tax base assets of, if carrying amount of liability is greater than the tax base liability, then it will be DTA. So this is DTL and DTA position. Now if we are calculated this deferred tax, after tax this calculation of DTL, we need to check closing balance of DTA or DTL that would be appear in balance sheet. So where the we will disclose this deferred tax or deferred tax liability in balance sheet. In balance sheet, whatever the temporary difference we are getting into the tax rate. Now amount of DTA, amount of DTL to be recognized in profit and loss account or OCI in current year. So where we can transfer it to OCI also. Now closing balance of DTA. DTL is calculated based on whatever the opening balance we have. DTA we need to check out. Now deferred tax expenses is recognized in profit and loss account or OCA according to the item on which it is created. After that, if via DTA or DTL is recognized in year or revised in future year, so sometimes we will reward that amount, sometimes we need to reward that amount in future. The tax rate to be used for calculation of DTA DTL for future tax rate specific to the transactions, that is substantially enacted tax rate will be used. Substantially enacted tax rate means here tax rate which is announced by government, that rate will be used before balance sheet for upcoming year. Now we should use these cases. Firstly, for if you are following, what are the steps we can use for calculation. Firstly, we need to calculate the carrying amount of asset liability in per books of account. After that, tax base of asset or liability as per income tax act. Now we need to see the difference, that is TD, that is temporary difference or deductible difference. Temporary taxable difference or deductible temporary difference. Now we need to calculate DTA DTL on the temporary difference. If closing balance of DTA or DTL and the amount of DTA or DTL to be recorded in profit and loss account, so closing balance will be shown in balance sheet and the amount, current year amount will be shown in profit and loss account. Now if required, we need to pass the general entries. Now some cases, if we have some cases, some different cases will be taken, how we can recognize the amount for the different cases. For example, we will take the case by case. So if you are having the cases like we have transactions example, so we have some situations and we have some treatments. Firstly, parent. Now investment is there. Investment is in subsidiary, associate or joint venture. So we have some investment in associate, subsidiary or joint venture, that is assets. Then carrying amount will be, what will happen. Carrying amount will be the whatever the amount we are invested here, the cost amount we will consider plus or minus. So plus or minus we will consider what is the share of profit you are getting, profit or loss you are got from this subsidiary or associate or joint venture. So in our parent company balance sheet, it has investments. For that investment, it will get the share of profits. We need to add or less. If it is profit, we need to add. If it is loss, we need to deduct. So now you will get the amount, that investment amount you will get as per books of account. But as per income tax, investment amount always it will be the cost. So the difference between this amount will be the temporary difference. If it is more or if it is less, we need to check out. If it is taxable or deductible, we need to check out. That is first case, parent company related, and that another cases. Now next we will take 116 related case. 116 related case, what is there? If we are taken asset on lease, so we are taken on asset on lease. If we see in asset, if we take the any asset, we will calculate lease liability and ROU of asset. Now ROU of asset, lease liability. Now as per books, as per Ind AS 116, carrying amount means what? Carrying amount means net amount of ROU asset, net amount of ROU asset, and the lease liability as per books. That is, we will get closing balance of ROU in balance sheet date minus closing value of lease liability as balance sheet date. This is carrying amount, where if you go as per income tax, the tax base, income tax base nil. Why it will be nil? Because since lease rent is allowed for deduction on payment basis in income tax, so they will allow whenever you paid that lease liability, lease payment, it will be allowed as a deductible amount. So whenever you are already getting the deduction, then there is no carrying amount now. So carrying amount, this will be carrying amount and this will be tax base. The difference will be the amount it will become. Now after 116 we will talk about 102, that is share based payment transactions. Now share based payment transactions, what will happen here? Share based transactions amount, if we have carrying amount will be nil, and tax base will be employee benefit expenditure to be recognized till date based on the intrinsic value of option we will take. So intrinsic value of option based on the benefits, employee benefit expenses, we are recognized till the date we will consider. Here share based payment transactions is considered as an asset. So this, if we see share based payment, normally entry will be share based payment expenses account debit to whatever the cash or bank account, we will put the entries, that is the entry. So now this amount share based payment will become the asset. This SPP transaction is considered as an asset, hence always will come DTA, will be recognized as SPP transactions. If we see any share based payment transaction, you will always get the DTA positions, that is the main case. Any assets or liabilities relating to any expenses that is not deductible or not allowed as per income tax act, any income is not taxable on income tax. For example, if we see if we are given any donation, so donation to charitable trust is allowable in income tax, but if you are given the donation to unregistered trust, then there will be not allowed as deduction as per income tax act, or some penalties or some income tax demands, it will be not allowed as per income tax act. So whenever there is not allowable as per act, then no DTA or DTL will be created, is assuming that tax base equal to carrying amount. Whatever the amount we are paid, it will be considered same as tax base. So there is no DTA or DTL positions. Next one, after that we will talk about the carry forward losses. So carry forward losses as per income tax act is deductible temporary difference. Here on which DTA is created we will calculate. After that we will talk about the MAT, that is maximum allowable amount. Credit as per income tax act recognized as DTA, that is the case. Now if we are seeing another standard like 103, business combination is there. Business combination, we are taking any asset, we will take on net assets taken on business combinations. The net asset will be taking based on fair value. So if fair value, then the treatment, the carrying amount, if carrying amount as per books of account greater than tax base, if carrying amount as per books of account greater than tax basis, then we need to create the DTL. Or if the carrying amount, if the fair value, if that this fair value is carrying amount, carrying amount as per books of accounts and tax base. If we see the tax base less than, we need to create the DTA position. Now whatever we are creating, this DTL or DTA we are creating will be recognized through goodwill or capital reserve on assets, liability taken over on business combination. Or whatever this DTL or DTA will not be created on goodwill arised in business combination, since it will make some circular references. In this case, if it the whatever the tax rate for calculating this DTA or DTL will be rate applicable to acquiry entity rate will be considered. Acquiry entity rate will be considered. If tax base is not specifically given in any cases, now whatever the existing carrying amount of assets and liabilities in books of accounts of acquiry will be considered for tax basis. Acquiry books of accounts amount will be considered for cases. Now for to create the DTA, so we are creating the DTA positions we have. So deferred tax amount was completed. On business combinations we are completed. Business combination position we are explained. Business combination share based payment completed. Share based payment transactions was completed. Entity status disclosure. Before that disclosure, we will talk about the business combination. If any transactions was missed, DTA offsetting. Offsetting here, offsetting will be offsetting of DTA and DTL. Current income tax, deferred income tax. Current income tax legally enforceable right, intention to settle on net basis. Deferred income tax, when current tax can be offset by the same tax authority, will be allowed to set off. Now here what will tell about this offsetting? Offsetting means simply offsetting of current tax and current liability, or offsetting of deferred tax asset and deferred tax liability only if entity has legally enforceable right to set off the representative tax asset and liability, then it will be allowed to offset. Only it will be allowed same to same taxes. Not we cannot set off current tax with deferred tax. It will not be allowed because both are not same. Now we are going to recognize this deferred taxes, deferred tax assets. Whatever the rates we will take the amount accounting of this DTA. How we can recognize the DTA? So DTA has some cases. DTA has some cases. Always if you have DTL you can create, there is no problem, but for creating a DTA you need to satisfy some condition. You need to satisfy some conditions for recognizing a DTA. Now entity firstly should recognize DTA only if it is probable that there would be sufficient taxable profits in future. So if we have profits in future, if we assume the profits will be there, sufficient profit will be there in future, then and only you need to create the DTA. Now another point, if entity anticipates losses in future, if for example if entity anticipates loss in future, that is no profits in future, then DTA is recognized. For the recognition of DTA we need to check out the two priority basis. First priority will be the lower of what is the deductible temporary difference amount, what is the deductible temporary difference amount, or whatever the profit that can be generated by implementing tax planning strategy, and whatever the cost, if you incur any cost for implementing this strategy, this amount will be created as DTA. This is the first priority. And the second priority will be same, lower of reversal amount of deductible temporary difference in future or reversal amount of any taxable temporary difference in future year. This is the second priority, that is the DTA condition will be satisfied. After that, tax rate reconciliation. Here we have seen the tax rate related na accounting for amount deferred tax, accounting tax, DTL DTA will be tax rates, distribution of dividend, tax rates. Here whenever we are reconcile the tax rates, how we can reconcile this tax reconciliation. So for tax reconciliation we will check out the amount whatever the balances. Firstly, tax reconciliation in absolute numbers, we can go with the absolute numbers, and that reconciliation between tax expense and tax on PBT as per books we need to check out. So profits before tax as per books, tax at the rate applicable tax rate, that is PBT as per books into tax rate, you need to check out. And after that, for this we need to add the tax on items which is not deductible or not allowed as per income tax act. So whatever the profit before tax we are taking, for that we are using the tax rate, applicable tax rate, we will get the amount of tax amount. So amount of tax amount we will get. After that amount we will add the amount which is not deductible, which are we are deducted already, so which is not deductible we will add back that amount. For example, like items which are DTA DTL is not created, that items will be taken, and we will get the tax expense of current tax expenses and deferred tax expenses. Now second, it will be tax rate reconciliation. Now we will reconcile the tax rate reconciliation between the average effective tax rate. So we will take the average effective tax rate and the applicable tax rate we need to check out. For that we should take the first applicable tax rate plus the tax on items which is not deductible or which is not allowed as per income tax act. We need to add back that items. For that we need to multiply with 100 and we will get the average effective tax rate for that amount, that is tax expenses divided by PBT, profit before tax amount. We will get the amount. This is India 12, that income tax case. Now we will give the summarized story of this income tax. So firstly we started with the definition of the income tax. So this standard, simply we started with deferred tax. India 12. We started with the definitions. Firstly we talked about the definition of what is current tax. What is current tax? Current tax means simply it means tax expenses recognized in books of accounts, amount tax payable on profits calculated as per income tax act, that is current tax rates. After that we talked about the deferred tax. It is temporary saving on tax or paying some additional tax due to they have some temporary difference between the carrying amount and tax base of amounts assets liabilities. For that we are taking some example of depreciation. How we can pass the entries for this amount? For we talked about the entries like recognizing the current tax means current tax account debit to provision for tax, and current tax where he is recognized in profit and loss account OCI according to the items, and recognizing the advance tax if you paid any amount, advance tax account debit to bank account. After that we talked about the deferred tax. Now for calculation of this deferred tax, amounts, you need to check out the as per India's balance sheet approach used for deferred tax follow. So It is calculated temporary difference. We need to calculate the temporary different amount, whatever the amount we are calculating, temporary different between carrying amount and the tax base of assets and liabilities. After that, we need to check out the carrying amount as per balancing relevant assets and liabilities as per Ind AS. So as per tax base, as per Ind AS, we need to check out the balance, and we need to see the difference between the both. If this is a taxable temporary means it leads to pay additional payment in future, and that is we need to create the deferred tax liability will be created and taxable temporary difference. Here the carrying amount of asset greater than tax base of asset or carrying amount of liability less than tax base of liability. After that, we talk about deductible temporary difference. It leads to saving of tax in future. So deferred tax asset is created here if carrying amount of assets less than tax base of asset or carrying amount of liability greater than of tax liability. We talked here cases. After that, we calculation of this DTA or DTL amount. DTL amount we are calculated. So closing of balances, what is the DTA DTL should be appear in balance sheet. So where we can showing it will be balance sheet cases, and amount of DTA and DTL to be recorded in profit and loss account or OCI in current year. So current year we need to transfer this amount. So it is like a deferred tax expenses will be in profit and loss account, will be recognized, reversed in future. What will be the general entry for DTA and DTL entry? To recognizing the DTA asset account debit to deferred tax expenses, and whenever we are reversing deferred tax expenses account debit to deferred tax asset, so it is a asset, so we need to debit the deferred tax asset to deferred tax expenses. And for deferred tax liability, general entries will be deferred tax expenses account debit to deferred tax liability, and whenever we are reversing deferred tax liability to deferred tax expenses. Now we are seeing some special cases. Now we are seeing for some special cases. So what is there as per Ind AS 103, that is business combinations. If we are taking that assets and liabilities acquired in business combinations, for net asset taken over in business combinations, if the fair value treated as carrying amount as per books of account, if it is greater than tax base, then it will be created DTL position. If the carrying amount of as per books of account less than tax base, we need to create the DTL positions. We taken this amounts. After that, we talked about the this amounts, foreign exchange gains or liabilities. Whenever we have differences amounts, what we can do for this amounts which have the carry forward amounts, or which we have DTA recognizing some cases. Here there are some goodwill, na? Okay, goodwill we missed this one. Okay, DTL will be recognized through goodwill or capital reserve on assets and liabilities taken over in business combination. DTL will not be created on goodwill, so we will recognize it through goodwill, but we will not created on goodwill arising in business combination, since it will be given. In this case, tax rate for calculating DTL will be calculated rate will be applicable based on the acquiry rate will be considered. And here initial recognition creates a circular reference, and if the tax base is not specifically given in cases, existing carrying amount of assets and liabilities in books of accounts will be considered for that cases. And entity recognizing the DTA, what is the position, DTA positions we are checking. And after some cases we deferred, we are talking about the business combinations. If you have any undistributed profit, foreign exchange rates, reduction in recoverable amount, we need to recognize that amount. And parents and subsidiary, here if you have investment in subsidiary, associates or joint venture, what is the carrying amount for that? Carrying amount will be investment amount plus or minus share of profits of subsidiary associate joint venture, that is the carrying amount. Tax base will be investment amount, that is cost. The difference will be, we need to check out. In case of investment in subsidiary, no DTA, no DTL is recognized on temporary difference, as parent entity will be able to control the timing of its reversal. Next, if relating to this amounts, whenever we are talking about India is one this SSC tax assessor tax cases, T deferred tax determining the law tax rate. We'll talk about this tax rate, deferred tax amount, and some deferred tax DT offsetting was discussed in later. Business combination, we talked about this business combination 113, and our tax based principles. Share based payment, okay, share based payment means here carrying amount will be taken in tax base, that is employee benefit expenses to be recognized till date based on the intrinsic value of option. We need to check out here. Share based payment he is considered an asset, so we consider as asset, so we always will DTA will be created for this cases. That is the main cases for India AS 102. Change in status disclosure, so we need to disclose these items. This is relating to India AS to if we are disclosure temporary difference, we need to disclose these items. Whatever the items whatever we are done, we need to disclose those items.